Good morning, everyone. Robert Rayburn here from Life Pro Asset Management. Hope that everyone is having a good week so far. Being Wednesday, this is a little bit later than we typically distribute our weekly update, but we did want to incorporate some of the volatility that's hit the market here, really starting since last Friday. So Friday, Monday, Tuesday, we had really 3 days in a row where we've seen a pretty decent asset rotation hit the market. Very normal. These things happen in June. They happen back in May. They happen every few months where some of the winners get hit. Some of the losing, more junk-like stocks tend to play what's called a catch-up trade. So we're going to go through the factors that are really sort of driving this asset rotation, what it means for your portfolios, what to pay attention to, and really what not to pay attention to, and how to stay focused on the long term. The second thing we're going to go over today is how to manage some of these large gains that we've seen since March. Sometimes what happens is when investors, whether they're advisors, whether they're institutional investors, whether they're retail clients, everyone alike, when you realize or you're experiencing large gains, you might be tempted to say, hey, you know what? Now's the time to take some profits. But it's all a matter of context. And what we're going to go through today is to really understand what's driving the gains if we go back through March and even prior to March. And then secondly, where are we at in this current recovery? Overlaying that relative to 2009 so that we can understand both the opportunity and the risk going forward. And then we're going to do a quick corporate earnings update, and as we do every week, look at the corporate credit market and making sure everything is healthy over there. But overall, the performance remains exactly where we want it to be. We can't complain here. We're up 47.32% as of August 10th. We did have it was about 2% pullback yesterday, so that's not incorporating that into the 47. So overall, though, the performance remains fantastic. We're just around 43.31% ahead of the S&P 500 here in 2020. And then since inception, up around 140.07%, or just under 90% ahead of the S&P 500 after fees. When we think of the current growth correction that we're seeing in the market, we largely think we're kind of, I would say, sort of maybe 6 to 7 innings through this. We may have another day or two of this, and quite frankly, we needed it. As we said before, investing is a marathon, and every once in a while we have to catch our breath. And the great thing is that all of the companies we're investing in right now are reporting fantastic numbers. We'll have another slug of companies report numbers here at the end of August and the beginning of September. But other than that, things look absolutely fantastic. Now, why does stock picking matter so much? When we think of where are we since the prior peak of the S&P 500 in mid-February. So as we know, mid-February, the market hit a peak. We sold off drastically during the coronavirus bear market of March of 2020. And now what we've seen is the S&P 500 has largely come back. Still sitting a couple percentage points from its all-time high. But what's interesting is that the mega cap stocks such as Apple, Facebook, Google, Facebook, are really driving the recovery. And for the record, we actually are not invested in any of those companies. But what's interesting is that when we look at the percentage of stocks on the S&P 500 that are still far below their prior 52-week high, it's quite significant. So what we see here is that overall, about 26% of stocks on the S&P 500 are still 0 to 5% off their 52-week high. What's more interesting is that greater than 20% of the S&P 500 right now is more than 38% away from its prior 52-week high. Meanwhile, the Life Pro Asset Management Tactical Opportunity Portfolio is about 26.5% above its prior 52-week high, which was in mid-February. So in other words, had you invested in the S&P 500 in mid-February, you'd still be a couple percentage points lower. Had you invested in any random individual stock on the S&P 500, you would be far below the 52-week high posted in February. But had you invested in LifePro at the very peak at mid-February, you'd be 26.5% ahead of where you were at the prior peak in the market in February. So in other words, what we're trying to really get at here is stock picking really does matter. Indexing is great. It provides a great way to get you trained on the market, getting you that discipline to get, to continue to invest in the market and understand the ups and downs of the market. But to squeeze more return out of the market, to make your savings and your investing more efficient, what we have to be able to do is try to avoid, to the best of our ability, those areas of long-term decline within the S&P 500 and focus our firepower on those companies that are going from good to great, that are positioned for long-term growth. Now, the other thing we talked about here at the beginning was, where are we in the recovery? What does a recovery look like? One big fear out there is that the market's gone up too far too fast. We've heard this concern before, and that concern was in 2009. When we think of what happened in 2009, the bank bailouts, no one really was held accountable for what happened in the mortgage meltdown and the housing meltdown that ensued. And there was a lot of animosity toward the markets as a whole, toward Wall Street as a whole. And that caused a lot of people to not participate in what was one of the best bull markets of all time. In fact, I believe the best bull market of all time. So what we want to do is make sure that we're avoiding the same mistakes that a lot of investors made in 2009 by not repeating them today. So what we did was we took both the 2009 recovery and the 2020 recovery, and we said, if we overlaid the first 99 days off the bottom of the market in March, what does it look like when we compare the first 99 days of the 2009 recovery in March of 2009? And what we can see here is the red line is the 2020 recovery, and it's got remarkably high correlation to the 2009 recovery. So we can see here, very tightly correlated in terms of its movement. And when we look at the first 30 days, there was about a 27% return this year. There was a 23% return in 2009. The first 60 days, both in 2009 and 2020, we were up around 39.6%. That's unbelievable. That's 2 basis points from within each other. And then the first 99 days, so in other words, ending August 10th, 2020, we posted a 49% return off the bottom of the S&P 500 versus in 2009, a 44.8% return. So we've generated a 49% rate of return. That's a lot. So people might be tempted to say, hey, it's time to take cash off the table, but not so fast. Our work suggests that we are just getting started on a multi-year bull market recovery. And look what happened to those people that took money off the table in 2009. We saw here they no longer participated in one of the greatest bull markets of all time. In fact, 3 years afterward, that 44.8% return jumped to 102.63%. And 5 years later, it was 177.6% return. So what we want to do is understand that these numbers, this 49%, this 44.8%, seem large, but that's because we're coming off a drastic sell-off in March. And our work suggests that the recovery is increasingly looking like it's V-shaped. We're seeing broad participation in the overall bull market recovery. We see that actually with the rotation that's hit the market here in the last week. That's because some money's rotating out of tech, out of the consumer stocks, and into industrials, financials. That's actually a symptom of long-term health. And one of the big things that's causing that is this liquidity tsunami that the Fed has initiated. Now, we can argue 7 ways through Sunday in terms of whether or not this is healthy, whether or not this is justified. But the reality is, us as investors, we have to say, for a given action, what is the impact on asset prices? And the reality is, from a historical standpoint, when you get a liquidity surge, whether it's like in 2009 over here or right now, absolute record liquidity tsunami, what is that impact on asset prices? From a historical standpoint, it's incredibly positive on asset prices. So we don't want to fight the Fed. Real quick here, in terms of that asset rotation here, we can see this was just on one given day where the last 12 months, the best performing stocks were down 1.4%, while the worst performing stocks were up 3.2%. This was about 2 days ago. I believe this was on Monday. This is a reflection as to why our portfolios have pulled back a little bit, while we've seen the overall index kind of hold up. And that's really a reflection of the airliners, the banks, the cruise liners. These are stocks that we're not really focused on right now. They are experiencing little to no growth, and quite frankly have too much debt on their balance sheet for us to risk our client capital on. So we're focused on long-term growth. And in fact, when we look at two sectors here, and we haven't labeled it, but the chart on the left is the software sector, and the chart on the right is the airline sector. As you can see here, we've had a nice healthy pullback over the last week or so, while the airlines have had a pretty vicious pop here. It doesn't look like it when you look at the long-term chart, of course, but you can see here we've had a nice pop. But why don't we try to chase this airline rally? We don't try to chase it because they have little to no growth, they have massive debt, and in fact, the cost of debt is greater than the return on invested capital. In other words, over time, they're destroying shareholder equity. So we don't want to necessarily, that's not where we want to position portfolios for the long term. And of course, they have intense competition. Versus in the software sector, we see above average growth both on the top line and the bottom line, a very safe balance sheet, low levels of debt, and what we call a monopolistic platform. In other words, a lot of these platforms, a lot of these businesses are very much, they look a lot like a platform, very low levels of competition, and that's able to sustain high gross margins, which of course in the future delivers very high free cash flow. And that's why we see high and attractive return on invested capital with these types of companies. So this is what we're really trying to focus on for our long-term growth investors. Real quick on earnings. You wouldn't believe it by reading the media, but over 82% of companies so far in the S&P 500 are beating their earnings estimates this quarter. Yes, expectations have come down. That's the number one pushback that we get. So what? That's the point of the market. It's to beat expectations. What's priced in, what's not priced in, and guess what's not priced in? Earnings beats. And we can see here, overall, the 12-month forward earnings projection for the S&P 500, those forward revisions are starting to creep higher as we head into 2021. So again, corporate America doing a really good job in terms of adapting to the current environment, cutting out costs from their system, at the same time shifting their business models to chase growth where they can. Lastly, credit risk just continues to decline. This is something we always keep a close eye on. If we were to start to see this widen out, that would be a sign that we may be revisiting some of the damage back in March. But so far, so good. The Fed's done a really good job. So overall, the long-term recovery is just getting started. We do not want to chase those junk stocks for short-term gains. Don't try to be day traders, be investors. And that's why stock picking is so critical. We want to make sure that we're focused on the long-term, healthy areas of the market. That's really where we can deliver long-term alpha or outperformance for our clients. And we're going to stay that way. We're not going to try and chase 1 to 2 week rallies in junk stocks. So overall, the credit markets continue to heal. The broader economic picture continues to heal. And so we're staying on offense. So if anyone has any questions, please feel free to reach out to our offices at 888-543-3776, or you can reach me on my cell phone at 858-354-5255. 5114. Thank you so much for your business and have a fantastic week. And please enjoy the rest of the summer. Thank you.